If you've ever felt like the world is obsessed with instant results, you're not imagining things. People are living paycheck to paycheck. Companies are managed quarter to quarter. Financial markets hang on the next Fed announcement. Politicians make decisions aimed solely at winning the next election cycle. Entire industries have been created just to be sold to the next investor willing to pay a premium. And somehow, all of this chaos is being held together by loans written just long enough to be packaged into financial assets.
This month, the Bureau of Labor Statistics failed to publish its monthly jobs report because household survey data couldn't be collected during a government shutdown. On the surface, this seems like a small inconvenience, but the immediate problem is huge. The Fed can't make informed interest rate decisions without accurate data. Economic strategy requires long-term planning, but today, policy is reacting to short-term noise, and the market rewards those who can adapt quickly. In many cases, bad news is now interpreted as good news. People are hoping for higher unemployment because it can lead to lower interest rates. Lower rates mean cheaper borrowing, which fuels speculation, creating profits for some while masking the deeper economic fragility.
Take Klarna, the buy now, pay later service. On paper, it seems like a convenient financial solution. Pay for purchases over time, interest-free. But in reality, Klarna is burning through cash. Its net losses more than doubled in the first quarter. The company isn't profitable, yet it continues to attract massive investor funding. This isn't an isolated case. Most buy now, pay later companies operate at a loss, financed by venture capital and private equity. Meanwhile, consumers rely on these loans to survive day to day. What you see is households who can't pay up front for groceries or rent being supported by an industry that itself can't sustain operations without external funding. The irony is stark. Even if this sector collapsed tomorrow, insiders would walk away rich. Founders and early employees cash out life-changing sums. Investors enjoy returns that look good on paper. Regular people are left financing burritos and basic expenses. Nobody in the middle is truly making money, but everyone at the top does. This is the essence of short-term thinking, extracting immediate value while placing long-term consequences elsewhere.
Humans are wired for instant gratification. Our brains seek reward now rather than later. Historically, businesses and investors rewarded long-term planning. Saving, reinvesting, and operating with patience were the keys to sustainable growth. Today, markets reward short-term wins. CEOs cash out after a few good months rather than building a decade-long career. Stock buybacks and capital gains dominate strategy, and dividends, once the main source of investor income, are at historic lows, approaching just 1% in many cases.
This shift fundamentally changes business incentives. Companies prioritize asset flipping over long-term growth. They acquire other companies or leverage debt to boost stock prices instead of investing in innovation, R&D, or employees. Low interest rates amplify this effect. Cheap debt encourages borrowing to speculate rather than to generate cash flow. Bad economic news, like rising unemployment, paradoxically becomes good news because it may force the Fed to lower rates, boosting asset prices. This system rewards insiders legally. Executives are responding rationally to incentives. If given the chance to secure generational wealth through stock buybacks or short-term maneuvers, most would take it. The structure encourages this behavior, not recklessness. Legal frameworks and regulations are designed, or at least interpreted, in a way that allows extraction of value while the broader system absorbs the long-term costs. These dynamics are not limited to finance. Politics, startups, and industries follow the same short-term logic. Venture capital pushes founders to exit fast. Politicians make decisions for immediate approval ratings rather than generational impact. Short-term thinking dominates because it is rewarded structurally at every level. Even regulators often operate on short-term incentives, creating a cycle where the immediate payoff outweighs long-term consequences. Consider stock buybacks. Before 1982, companies had two main options with surplus cash: pay dividends or reinvest in the business. Dividends rewarded shareholders directly, while reinvestment built sustainable growth. In 1982, rules changed, allowing companies to buy back shares instead of reinvesting in fundamentals. This shift encouraged management to manipulate stock prices, boost short-term valuations, and tie executive compensation to share performance. Today, companies buy their own stock at record levels, often using borrowed funds, while households and pension funds become net sellers. Genuine reinvestment in business operations has declined dramatically. The rise of low-cost brokerages and retail investors accelerates the cycle, but the real driver is large shareholders who need liquidity. Over the past 5 years, markets have shifted from rewarding profit creation to rewarding asset flipping. Companies make money not by running profitable operations, but by speculating on assets that could eventually be profitable. Interest rates play a central role. Cheap borrowing reduces the need for immediate cash flow, and speculation thrives. This has transformed how bad news is interpreted. In the past, weak employment figures would spook markets because fewer jobs meant lower demand. Today, weaker numbers may push rates down, driving asset prices up. Markets now prioritize financial engineering over underlying business health. Executives, investors, and companies act rationally within these incentives, even if the result seems counterintuitive to ordinary observers. The human element is unavoidable. Given the opportunity, anyone would respond to incentives that maximize personal or corporate gain. Short-term thinking is not a bug. It is baked into modern market structures. The challenge is that while insiders profit, ordinary people face stagnating wages, rising living costs, and increasing debt. Every layer of the economy, from policymakers to consumers, participates in this system, knowingly or not. Understanding these mechanics is essential. Consumers, investors, and employees can navigate a short-term world more effectively if they recognize the rules. Awareness allows strategic positioning, timing decisions, risk assessment, and capital allocation based on market incentives rather than conventional logic. Short-term thinking will continue dominating markets until structural incentives shift, but knowledge gives a critical advantage. Ultimately, short-term thinking is a feature, not a flaw, of modern finance and business. It defines how markets operate, how companies manage resources, and how individuals accumulate wealth. Recognizing this truth allows us to respond strategically, survive, adapt, and even profit, while others chase ephemeral quarterly rewards. The world may reward speed, opportunism, and extraction, but insight and patience create opportunities that last far beyond the next report.